A mutual fund is a type of investment vehicle that allows many people to pool their money together to invest in a variety of assets, like stocks, bonds, or real estate. This diversification helps reduce risk and increase potential returns. Types of mutual fund. There are mainly three types of mutual fund. First is equity fund, second is debt fund, and third is hybrid fund. First, we talk about the equity fund. In the equity fund, your money invested into stock market. Equity mutual funds can be sliced and diced in several ways depending on the goals of the fund. First, funds based on company size. First is large cap fund, companies with a market value of $10 billion or greater. Second is mid cap fund, companies worth $2 billion to $10 billion. Third is small cap fund, companies worth $300 million to $2 billion. Second, multi-cap mutual fund. Multi-cap mutual funds are diversified mutual funds that invest in stocks across market capitalization. In this fund, your money divided into three parts and invested into small cap, mid cap, and large cap companies to gather third. ELSS mutual funds. ELSS, equity-linked savings scheme. Mutual funds, also known as tax-saving mutual funds, provide a double advantage of potential capital growth and tax benefits under Section 80C of the Income Tax Act. Mainly in this fund, you can save your tax. Fourth, sector mutual fund. In this fund, your money invested into a specific sector like agricultural, real estate, manufacturing, etc. Fifth, index mutual fund. This fund totally based on stock market index like NSE Nifty, BSE Sensex ECT. Debt mutual fund. Debt funds invest in securities that generate fixed income like treasury bills, corporate bonds, commercial papers, government securities, and many other money market instruments. Mainly, you are invested your money in government bonds. First is liquid fund. A liquid mutual fund is a debt fund that invests in fixed income instruments like commercial paper, government securities, treasury bills, etc. Second is gilt fund. Gilt funds are debt funds that only invest in bonds and fixed interest-bearing securities issued by the state and central governments. Third is fixed maturity fund. A fixed maturity plans is a close-ended debt fund that comes with a fixed lock-in period and limited investment window. Hybrid mutual fund. Hybrid funds are a combination of equity and debt investments. Balanced saving fund. If you're 70% money invested in debt and 30% money invested into equity. Balance advance fund. If you're 70% money invest in equity and 30% money invested into debt.